Thank you very much, Mr. Hayashi. Perhaps you can stay on stage because you'll be moderating the next panel. Okay, we will now proceed to the panel discussion, challenges in introducing transition finance for hard-to-abate and high-emitting sectors in ASEAN, exploring pathways for sustainable solutions. Once again, if you would like to pose a question, you can use the Q&A function on the agenda in the ASIS app. It is my pleasure now to invite the following panelists on stage. Firstly, Ms. Assyl Ikhsan, the Executive Director, Sustainability Solutions from OCBC Bank. Ms. Megumi Muto, Deputy Chief Sustainability Officer, Mizuho Financial Group. And Mr. Seb Henbest, Group Head of Climate Transition, Global Sustainability, HSBC. As mentioned earlier, this will be moderated by Mr. Hayashi. Over to you.
So once again, thank you very much. So our earlier sessions by IEA and ourselves, ERIA, were presenting what is needed for enhancing ecosystem of transition finance. But let us do a little bit of a deep dive from the practitioners' points of view. And today, so we welcome 3 speakers coming from the members of Asia Transition Finance Study Group. And so we're really pleased to have 3 of them. So thank you very much for joining. So to begin the session, I would like to ask all of you to briefly introduce yourself, as well as introduce some of the transition finance activities at your entity. So maybe going from Assyl.
Yes, certainly. Thank you so much for having me on this panel. Delighted to be part of this discussion. So my name is Assyl. I'm part of the Sustainability Solutions team at Global Wholesale Banking at OCBC Bank. So the way we look at transition finance is a key pillar when it comes to sustainable financing strategy that we have at the bank. So we fully recognize that there are a variety of decarbonization pathways depending on geographies as well as sectors, especially here in Asia. So our approach at OCBC Bank is, in fact, to support transition activities and projects and credible transition plans with innovative and as well as existing financing structures, including transition loans and bonds, use of proceeds, as well as sustainability-linked products as well. So one of the examples earlier this week, actually, it's been announced that we were part of one of the banks that financed CCGT plant, Hydrogen Ready, here in Singapore, which was labeled as transition loan according to the Singapore Asia taxonomy. So that's one of the examples as use of proceeds type of transition financing. And obviously SLLs and SLBs are very widely known products in the market. But beyond that also, I think I want to acknowledge the fact that one of the findings that we do engage on transition more holistically as well from ecosystem perspective, because we recognize that when it comes to transition, it's such a nuanced topic that we need to engage stakeholders across the ecosystem, be it policymakers, fellow FIs, as well as industry players as well. So that's in short what we do at OCBC.
Thank you very much. So Muto-san.
Thank you very much. My name is Megumi Muto, or Deputy Chief Sustainability Officer at the Mizuho Financial Group. Mizuho has been in the business for the last 152 years, yes. So we have been supporting the many rounds of industrial transformations, first in Japan, Asia, and then globally as well. And our basic approach is really relationship banking, really having a long-term perspective with regard to the transformation and, in this context, transition of the customer. And we are not just financial institution. We provide non-financial solutions, including a lot of industry intelligence. So we think that we are well positioned for transition finance, where we need a long-term view industry analysis, benchmarking, as well as really encouraging by way of discussing at many layers every day. Thank you.
Thank you. Seb?
Thanks very much. So my name is Seb Henbest. I'm the Group Head of Climate Transition at HSBC, and I run a particular sort of specialist group within the organisation. So I run a group of transition specialists who've been brought into the bank to help us navigate and help to identify opportunities where they exist and manage risks at an enterprise-wide level. I was formerly Chief Energy Economist at Bloomberg NEF and author of the New Energy Outlook, and the people around me are really focused on finding the pathway for the bank and its clients through transition. And we know that transition, depending on whose estimates you use, 150 trillion, 200 trillion. I mean, these are eye-watering numbers, and that's an eye-wateringly big opportunity as we see it. And we have a firm commitment to be a net zero bank and to pivot our balance sheet over time with our clients towards low carbon. When we think about transition, and I think there's a really important definitional question here in terms of what do we mean by transition? And we're all using it like we're all on the same page. And I think there's a big T transition, a small T transition. Is that the same as sustainable? Is that like, how does it fit with green? And I think a lot of work's being done clearly to try and work through that. But maybe from my perspective, we've made a 750 billion to 1 trillion commitment this decade for sustainable finance, which is mostly green finance and sustainable linked products. But that's not all we're doing, and I think it echoes what the rest of the panel has said, is that when we say we want to be a net zero bank, that means working with all our clients on their transition. And whether it's 152 years or 160 years, we've been around a very long time, and that means that we've been part of growing the world economy to its current state, which means we have exposures, relationships, and a client base that in many cases is emissions intensive. So transition for us means working with our clients on their transition, and as financial institutions, all our emissions are in our clients' emissions. We have very small operational emissions, so really that means we need to be able to work with our clients on that decarbonisation trajectory. And so everything we do, in a way, with our clients, because every client has a transition agenda, whether they're moving fast or slow, whether they're in Asia or Europe or North America, they know this is all happening. So it's how do we work with our clients? So I think there is a labeled product element to this, but there is also what we call that big T transition finance. But the small T transition finance is how are banks and financial institutions mobilizing capital to support their clients as those clients work to decarbonize. And I guess a final thought on this is we're very focused on growing our business towards net zero as opposed to constraining our activities to achieve an objective on paper. And I think our clients are busy growing their businesses towards these objectives as well. And so we have to navigate the now as well as the future. And the now we see huge opportunity, and 93% of the investment that's that happens annually is going to these clean power ecosystems. Maybe the easier to abate in your report, the renewables, batteries, the grid, electric vehicles, their ecosystem. The last 7% of investment that we're seeing globally at the moment is going to those harder to abate sectors, heavy industry, clean fuels. And so part of what we're doing is trying to work to deploy those mature technologies in the clean energy, clean power ecosystem, EV ecosystem, but also scale the technology solutions that we're going to need to decarbonize, for simple terms, you could call the clean molecule space, and which is not yet economically competitive and requires a lot of attention if we're going to get to those net zero points by mid-century, even though the point, right now we're at a scaling phase, a growing phase, rather than a real sort of volume deployment phase. So transition is very holistic for us, far less specific.
Totally, thank you. So I think, we are already seeing this complexity of transition finance. But also I found, the commonalities that, the financial institutions are really there for the clients and, the partners and together growing and also contributing the entire economy. That being said, going to my first question to Assyl, maybe, while transition finance is critically important, transition finance in the region is yet to scale. So what do you think are the critical to make transition projects both commercially feasible and bankable? That might be a big question, but yeah.
Yes, and I think it's a well-discussed topic as well throughout this week, and I'm sure we're going to hear more as well at this panel and beyond. Look, I mean, no secret around the fact that a lot of investment will be required to transition away from browner sources of energy to more greener, and everything in between could be classified as transition. But to Seb's point, I think first and foremost, we need to kind of agree what is transition finance, right? And there seems to be multiple definitions and multiple approaches to take on it, but I think roughly there are two types of approaches that are not mutually exclusive. One is pure labeling and product perspective, be it from use of proceeds perspective or sustainability-linked banking products perspective, or the overall transition engagement where we actually engage with the client more on a strategic level to understand, okay, what are your transition plan is, what kind of activities are going to be involved, what are your medium and long-term targets are, and then kind of help to deploy capital to help our clients to achieve that, and de facto that how financial institutions are going to achieve our net zero goals as well. And to your point about how to make projects bankable, if I could come up with a wish list, and I think earlier, Megumi-san, you were presenting in the other room, the study group findings of the annual report, right, of ATF's study group. Generally, I think three major factors or elements when it comes to helping the projects to get to bankability stage. First one is the clarity around regulations and policy. That can involve frameworks as well, because we know we have multiple frameworks across the world, and luckily here in Asia we recognize the amber category as well, which is very critical for the transition financing, right? So as banks, if we want to label something as transition, we do need a reference point, and taxonomies can be helpful. But I think beyond that, carbon pricing as well as regulations and policies to support some of these technologies and projects to scale, funding, feasibility studies that go into prepare those projects to get to commercial feasibility. So clarity around policies and frameworks and regulations is one. Two is the revenue certainty and predictable cash flows that can be supported, for example, by firm offtake agreements. I mean, if I can put a wish list, that's probably going to be one of them. And it has its own nuances and complexities as well, depending on the industry. But I think largely predictable cash flows and revenue certainty, and that can be very, very helpful to get the projects to bankable stage. And third but not least, I think just packaging some of these projects in a way that can help to de-risk, so private capital can be deployed in that space and scaled and catalyzed. I think that's another one. It can be in the form of insurance or government funding, guarantees, etc. So those elements can help to de-risk some of these projects and package that in a way that banks can come in and provide financing, be it transition or not. But I think largely I would say those are the key three elements that can help to scale financing in the energy transition space in this region.
Thank you very much. So I think that's a very good point, and shows the importance of collaboration among the policymakers, MDBs, and private financial institutions. Maybe let me go to Muto-san for the next question. So as Assyl mentioned, so the ATF study group report, as well as maybe the ADB ERIA METI report, stated the importance of partnership among those different sectors. So from a private sector perspective, how do you see the significance of partnering with those governments or MDBs, and what are the expectations to public sector to mobilize private capital?
Thank you very much. By the way, until March, I was in development agency and DFI of the Japanese government called JICA, so I was more on the public side.
Perfect
So
person.
yeah, and then I transferred to the private side, and yeah, I can say what to expect to the public sector, but half of my brain says, okay, what am I going to do? From that perspective, maybe I'm rephrasing some of what Assyl Ikhsan already mentioned, but I think there are mainly 3 points, maybe from the public sector point of view. One is analytical. So the study by ADB, ERIA, and Mate is part of that. It's really providing overview, country context, and also points to improve together. That is really important. And then the second one is blended finance, or broadly speaking, including how to ensure cash flows and also how to ensure proper risk division mechanisms. And I understand that there are a lot of discussions going on in really raising the practicality of blended finance, not just in this region, but also in other continents as well. So blended finance is the second one. And the third one is capacity building. And capacity building, yes, I was doing capacity building when I was in the public sector, involves a lot of things. So it involves technical assistance, which is not just about sharing knowledge about specific technologies, but it's also master planning, feasibility studies, training people. That is very essential, but very critical for this as a role of a public sector. And then, most importantly, the policy framework. Yeah, especially when NBBs as well as the DFIs are concerned, capacity building really involves a lot of interactions in order to make sure that we can jointly keep the investment environment sound and very clear. So these addresses some of the policy and risks that you just mentioned. Thank you.
Thank you very much. And you mentioned the policy framework, and then I think one of those attempts could be the ongoing taxonomy and other attempts to create regional roadmaps. So let me come to Seb on this. So how is HSBC approaching and supporting transition activities? Well, we mentioned there are a variety of activities, but how is HSBC approaching them, given that some of the technologies and solutions may not be zero emissions?
Yeah, thanks. I mean, as I said before, we're working with our clients, and a lot of what they're trying to do is to navigate a pathway, which means that inevitably some of those steps on that pathway are not zero emissions, and we're comfortable with that. It doesn't mean it's incompatible with an ultimate net zero objective. And really, if we take that client-centric approach, which I think for financial services, it's a service industry, that's what we do, then the question, isn't how are we doing things that are not zero carbon, it's how are we enabling, to the best of our ability, our clients to do what they need to do. And some of these things are difficult to bank because they don't have the price signals. And whether you're talking about carbon pricing or other mechanisms, if things are not priced in the market, either because they're out of the money or there's just not a pricing mechanism, then it's very difficult to bank. And fundamentally, that's what matters. I mean, we're quite active in thinking through, from a carbon markets perspective, how we can crowd in. You may be aware, but we structured the largest ever outcome bond with the World Bank recently to support reforestation projects in the Amazon. So that was the first ever carbon removal credit-backed financing in international debt capital markets, and we're looking at more that model for more opportunities. And actually, we're investigating the carbon removal, carbon crediting, whether it's engineered or land-based. I think increasingly especially if we're looking at a 1.5 degree net zero outcome, is going to become more and more important. And that's a really important area where there are some things that are hard to abate and inevitably are going to require some pullback through those sort of mechanisms. The other area where we've been active and just investigating what's possible is something like the transition credits. And there's different models for this. We're actually co-leading a work stream under Traction, which is transition credit work stream in this part of the world. And we see potential for that. I think that there is a lot of work to be done on how that's baselined and the mechanisms there to make sure that that's robust. And fundamentally, any new crediting system or way of creating a price needs to be robust. It needs to have minimal carbon linkage. It needs to have additionality. It needs to have all the things that make carbon markets tricky to engineer and to regulate. But certainly, carbon markets is something that we're very focused on as a tool. But we're also just recognize that some of the things that need to be done are marginally unbankable. That it's not that they are far, far out of the money or there is no price signal, it's just they're difficult to do. And so we do have a joint venture with Temasek here, Pentagreen Capital, and its job is to work to find those marginally bankable projects with blended finance to enable them to get off the ground. And I think Pentagreen's just been appointed the fund manager for the Green Investments Partnership here in Singapore. So, there is stuff that we're actively doing and actively investigating. Lots of questions still on how we mobilize more, but fundamentally, we can't go faster than the market, and we can't go faster than the price signals, because it has to make good business sense for us and our clients in order to support these sort of investments.
They have to come together. So yeah, interesting that you mentioned the marginally bankable or marginally unbankable projects, and maybe so the blended finance, as Muto-san mentioned, is also the key. So let me come to Assyl. So obviously blended finance, so there's public-private cooperation would be crucial to unlock the situation of transition finance. And from your perspective, what sort of collaboration do you expect with the private sector or public sectors? And how can public sector and private sector share the risks, which would be one of the bottlenecks that we identified? Yeah, so that's my question.
Yeah, thanks for the question. So blended finance can be viewed as co-lending. So public sector and private sector lending together at a project level, etc. But it can also be viewed as, to your point, risk sharing, strategic risk sharing between public and private sector as well. And I think ultimately it can be quite powerful if we can align the incentives among public and private sector players to maximize the returns, be it monetary returns or not, between the different capital providers. Aligning incentives, I think, is the key word here, because public sector is coming in and their objective can be, okay, how can I de-risk this project to ensure that I can crowd in and catalyze private capital into the space. The space meaning energy transition, right? I mean, in this context. So I do believe that if we can align those incentives, we can really create a lot of value by bringing in and crowding in private capital, and everyone can actually add where they can add the most value from their perspective. So for example, we were involved in, we were the only Singaporean bank, actually one of very few Asian banks involved in UK CCS projects. And I think the public and private partnership really worked beautifully there. And what I mean by that is public side came in and set out the frameworks and regulations in place, underwritten all the risks that the private sector cannot underwrite, created a whole ecosystem and brought the relevant parties in together to ensure that the business case works. And that enabled a lot of banks to come in and provide project financing for these projects. And it really did crowd in a lot of private capital in that space. And I do believe that it's a good blueprint to refer to in a energy transition technology space where governments and public sector can come in and unlock private capital and really catalyze private capital into that space. Because going back to the point of my fellow panelists, at the end of the day, it does have to make a business case. And I think the public sector's role is actually to do that. And once they can unlock that and address that, I see no issue private capital flowing in. I mean, I hope you agree with me as well, because I think from financing perspective into any of these space, I don't think there's necessarily shortage of capital. Banks are very much keen to explore and support our clients in this space as long as they're bankable and makes commercial sense for us and our clients. And the way to do it is actually for public sector to come in and help to unlock that. And they can do it through policies and regulations and underwriting the risk where private sector cannot really do that, and they're not set up to do that. So really, it's just aligning the incentives and using the strengths from both sides. Going back to my earlier point about what makes projects bankable is that policy element, regulations element, and the third one was the packaging, right? So how can you bring the insurance guarantees, grants, feasibility studies, funding, etc., that can help to really unlock some of these capital in the space. So yeah, hopefully we're going to see more of that in this region as well. And yeah, looking forward to be part of these transactions going forward.
Yeah, thank you. Maybe I'll come to Seb first. Yeah, to hear your view on those topics on how public sector and private sector can collaborate. And once again, I mentioned the recent activities on decarbonization pathway and taxonomies. These are becoming the framework for the region. So how does HSBC use those pathways and taxonomies in financing decisions?
Well, we use both in how we go about addressing transition. I mean, I'll take one at a time rather than try and talk about them both together. So in terms of taxonomies, they're very useful partly to help de-risk what we're doing and partly to help us reduce the transaction costs of what we're doing, because there's a lot of internal questions that get asked around this sort of categorization, especially if we're talking about labeled products. And then there is also on the risk side, when we get into the technologies or the activities that are less than squeaky green clean, there's a lot of questions about, hold on, what is that? So the taxonomies are really useful. We have established an internal taxonomy and sort of governance around that now. We haven't invented it ourselves. We've certainly leveraged the taxonomies that exist. It's based around 4 themes. There was a climate sort of green pillar. There's a social pillar, an adaptation pillar, and a nature and biodiversity pillar. And in terms of sort of transition, really, that the climate green is closest to sort of the sustainable architecture about what do we define as a green product. And next to that, you've got this question, well, what about that category of things that's not in that bucket, is not green, but is also climate aligned, climate positive, and maybe falls under this transition umbrella. So we're looking at that at the moment. We're certainly doing a lot of thinking about how we incorporate that. We know that there's a really good taxonomy here in Singapore, possibly best in class in terms of defining that. But the way we approach it is, in 2 tiers. One is to use the global taxonomies that exist, whether that's Climate Bonds Initiative taxonomy, the IEA's Clean Technology Guide, to create this sort of global framework. But then we look at over 50 regional and sort of sub-global taxonomies to help set the conditionality within that framework. Because it doesn't make sense for us to apply a taxonomy that is global to a region necessarily, or from one region to another. And because there's not just one master taxonomy for all this that would make it so simple. We have to navigate that complexity. And so we certainly use taxonomies. We have to try and fill in the gaps as best we can. And ultimately, you know, this transition category, or I think in Singapore, the amber category, there's different nomenclature, but we see a lot of benefit in that being well defined. From a risk management perspective, to help crowd in more capital, to reduce transaction costs, you know, there is just a category of things that we know are necessary that our clients are doing that doesn't fit in the green category, and it would be nice to be able to describe them in a useful way. So that's taxonomies. Pathways. You know, we have to think about pathways in terms of understanding the technology space. And big thing my team does is to understand those pathways and help to embed them in the bank. So the frontline banking teams understand better than they might otherwise what is a technology pathway for the different industries that we bank, and therefore can look out for those opportunities and work with their clients on them. But those pathways are a guideline because they change, not necessarily the technologies, but the rates of change, the decarbonisation scenario. So we've got to differentiate between the pathways that describe the technology and the pathways that are normative climate scenarios that describe the rates of activity, because then we can get misaligned from the market if we're following a pathway and the real market, the real economy is not doing that, and that's a big problem for us. Finally, on pathways, I just say, you know, we have interim 2030 financed emissions targets for the most emissions-intensive, energy-intensive parts of our portfolio, and those are developed based around sector pathways that emerge from these scenario exercises. So we use them explicitly to help us set those interim target points that help us to sort of steer our balance sheet and steer our portfolio towards ultimately the goals that we've set to be a net zero bank.
Yeah, thank you. Yeah, I think it's, well, at ERIA, we also published the pathways. And so it was really interesting to see or hear we need to be aware of the gap with the real economy and pathway. So the pathway, has to change and adapt to the real situation. So yeah, thank you very much on that. So lastly, coming back to Muto-san, so as we experienced over the past 30 minutes, so transition is a broad concept. And so what areas do you see opportunities in the transition finance? And well, as the lead of the ATF study group, how can we support to expand the coverage to these broad transition themes?
Very much. Hello. Yes. Thank you very much. As I stated before, Mizuho has a long history of supporting our clients to transform when it is necessary. One of the president banks of Mizuho is the Industrial Bank of Japan, and it so happens that all of the hard-to-abate sectors, not just power, but also transportation, materials, including chemicals, manufacturing, they are our main clients. And we, as a financial group as a whole, we put a lot of our priority in really navigating together through engagement as well as industry, sector analysis, discussions towards transition of these clients. And in that navigation, the pathways that the Japanese government in the context of Japan and what ERIA produces in the context of ASEAN is really, really critical. Our industry research team is very strong, and it does analysis, for example, similar to those of the World Bank sector analysis. But yet, we always refer that against the pathways that is available in Japan and also in the ASEAN context. And that is really a very good process that enhances the credibility of the pathway that we share with our major clients. So in a nutshell, the hard-to-abate sectors are really our greatest opportunities. And 2 weeks ago, I was sitting with one of the biggest cement companies in this region, right? And the conversation was very positive, and we are very willing to navigate through, maybe not smoothly, but together in order to contribute to the decarbonization in this region. Thank you.
So thank you very much. And I guess time's up. So yeah, thank you very much for the panelists for the fruitful discussion. Thank you.
Thank you very much, everyone. Before you go down, I'd like to invite you up front for a group photo. Right. Ladies and gentlemen, this brings us to the end of the solar and storage track. Like to thank everyone here, our partners, Matty, for this as well. Before you go, please do share your feedback via the apps, the ACES app, and let us know how we can improve our program in future. So now it's lunchtime. I think this is what you've been waiting for. Lunch is at the same place, which is opposite this ballroom at the exhibition center. Thank you very much.